Hi everyone, my name is Dr. Ling Tring An. This is my second time showing up and sharing insight on this with this community, and it's definitely my pleasure. If you remember, last week we talked about debt and how to balance between getting out of debt and getting your savings and your investment, in place at the same time. So today we are going to talk a little bit more about the different steps and why you need to have these steps before you purchase your first home. So I'm going to share my screen right now. All right. So, really, really quickly, my name is Dr. Ling Tring An. I have been working in finance for over 2 years now. Before that, I had a very extensive background in education. Um, my doctorate degree is in piano performance, and I got it from George Mason University in 2022. But life happened. A lot of things, changed the trajectory of my life. And so now I work in finance and help people secure their financial future. So today we are going to talk a little bit about how to do that safely without exhausting your resources, without stressing you out so much before you actually make that big decision or make the move on purchasing your first home. So the agenda today, we are going to discuss a few things. First and foremost, short-term, mid-term, and long-term strategies depending on your goals. Number two, we are going to talk a little bit about saving vehicles that we have today, and we're going to explain it in human language, as I love to tell my clients about the right way to talk about finance, right? Because we talk, whenever you talk to a financial professional, sometimes they forget that you are taking the financial security 101 instead of 301. So I will try my best to break everything down in human language. Now, number three, we're going to talk about risk versus reward. What vehicles fall into the risk management category, and which one is more suitable for the growth of your wealth. And also sometimes it's also a hybrid. So yeah, tune in for this section if you are not sure or not confident of your knowledge about the available saving vehicles on in the market right now. Number four, we're going to talk a little bit about how to balance growth with safety. If you have a smaller budget, and I'm talking about, less than 1,000, um, around $1,000 surplus every single month, if you remember what surplus mean from last presentation. And then last but not least, we'll talk just a little bit about why buying a house is actually a big financial event that you have to plan for ahead of time, instead of like making instead of postponing everything until the last minute and then pull the trigger in such a short amount of time. First and foremost, let's talk about short term, mid-term, and long term. So, this is actually the core of my practice when it comes to financial planning. I divide everything in very small sections, and they are all revolve around short term, mid-term, and long term. So, what is short term saving? My short term saving philosophy is around emergency fund building, right? So, as we all know from the last presentation, is very important for you to build an emergency fund for yourself and your family, because life be lifing, right? As Charlene always said. And when life be lifing and it hits us with like a $5,000 bill one month for, I don't know, car payment or car, if you need to fix your car, or one of your car, like three of your car broke down. This actually happened to one of my girlfriends, by the way. So we need that liquid cash set aside so that we can take care of anything, right? So it is definitely not set in stone, the amount of money that you should have in an emergency fund, but depending on your job security, your income security, I divided them into three main categories. If you have a really, really high job security, for example, you work for the government or the military, or if you have tenure, with a university or something like that, tenure in the military, tenure with a university, then probably you would want to have at least 3 to 6 months of fixed expenses in your liquid bucket, and preferably you would save this in a high yield saving account, right? Because we have at least what 3.5% return every single year right now. So it's, like a little bit bonus cash. At the same time, it has 100% liquidity, so you can dig into it anytime that you need. Now, if you have a medium job security, so if you work at a corporation or if you're on like a contract base, you kind of know that you have that security within this certain amount of time. But again, you can get laid off anytime. We're seeing that right now with a lot of jobs out there, right? And even the government sometimes is shaky because you have government shutdown and whatnot. So for this type of jobs, I would 100% recommend at least 6 to 12 months fixed expenses, because you never know when the next time you're gonna get to secure the next gig. If God forbid, your job right now let you go, right? And nobody can really tell when that is going to happen. So it's just a good rule of thumb to have that kind of amount set aside. Now, low job security, I'm talking about people like myself. We're a freelancer, we're business owners. Nobody knows if we can close that huge deal within the next 6 months or even 12 months, right? So for this type of workers or people, I would 100% recommend even more than 12 months fixed expenses if possible. Right. So let's say your fixed expenses, mortgage, bills, utility, all the non-negotiable add up to like 3,000 a month or 5,000 a month, then you need at least 12 times of that ready in your emergency fund at all time. So anything happen, life be life in, you will have that kind of cash to take care of anything that you need. So that is short-term saving, very important, but most of the time people overlook it. Now, let's move on to midterm saving. So midterm saving in my practice applies to any plan that you want to execute within the next 4 to 10 years of your life. So it can be anything, right? If you're planning to acquire a new real estate piece, a new investment property, a new business, anything like that, and you want to pull the trigger within the next 4 to 10 years, then that would fall into the midterm saving. And of course, it would deserve a very properly structured plan. Educational fund, right? Who here has kids? I have one. My kid is 4 years old. She's going to kindergarten next year, and I have a ticking time bomb that I have to follow because I want to pull her here and stick her in a really, really good public school around the area when she turns 6. So educational fund, it can include anything, right? We have 529 plan. We could also use a custodial Roth for that purpose. But educational fund, also you want to plan for their college as well. Because, think about yourself. Are you dealing with any student loan? Do you know how difficult it is to get out of that debt? So if you already know how difficult it is and how much it put a kind of like um, a stop or a pause on your wealth building, then you would definitely think about, okay, this could happen to my child as well. And if the housing market and everything out there, the living expenses keep going up like it has been lately, then you would probably want to prep your kids for that. So an educational fund, I think about it these days as an essential, not even optional anymore, if you are a good parent. And then last but not least, large purchases. Do you need to change your car? Do you have a lavish vacation to celebrate maybe a 10-year anniversary with your spouse? Something like that, right? Within the next 4 to 10 years, definitely you need to plan ahead of time instead of just, going with the flow and just wait until you have this leftover money and decide that, okay, we're going to have to max out our credit card to make this plan happen, or we just cancel the plan altogether. Right, so that's this is a very important piece in financial planning that a lot of people miss. People tend to go with the flow. if you know what I mean. Now, last but not least, we have long-term saving, right? So these are the things that's going to happen within, I don't know, 10 years and above. For me, I'm in my 30, so I have a good, I don't know, 40 more years to plan for this. And so if I start right now, the minimum requirement for myself, I kind of set it up for myself as $50 every single week into a saving account. Right. So when it comes to retirement saving, there are a few things that you need to remember. Back in the day, we had this thing called three-legged stool: pension for fixed income and longevity, right? We have social security benefit for inflation buffer and also longevity, right? That's going to keep paying you until the day you die. Now, the third one is retirement, which I mean, not retirement, sorry, investment for potential growth and longevity as well, right? But that's a little shaky, especially when you already retire. You don't really want to risk too much in the stock market anymore, because come high reward also comes high risk. So that is a three-legged stool in the traditional sense. However, these days, a lot of people lost the pension already, right? If you're in business, you know what that means. You have to kind of set up pension for yourself, right? But the three-legged stool planning and rules still stay the same for a really, really good and peaceful retirement. So number one, we have to think about your fixed income for your fixed expenses. What are your fixed expenses every single month? Then once you find out what that is, you're going to look into your social security benefit, and you can kind of, pre-calculate it for your retirement already, based off of your current income and the trajectory. So that is fixed income. Now, if you are not set there are a lot of other options that we can do. And one of the financial vehicles that I know that could possibly give you the pension that you deserve is annuity. But that is going to be another discussion for another day. Or, well, you'll feel free to book a one-on-one with me so that I can talk to you more about that option. But anyway, number one is fixed income for fixed expenses if you want a peace of mind for your retirement. Number two, we talk about investments, right? So investment, not the number one priority when you retire, but of course we don't want to have to deal with FOMO, right? Fear of missing out. So what if during our retirement, during those 30 years or 40 years, the stock market, do really, really well at a certain amount of time, right? So we also don't want to forsake the investment altogether. We do want to maintain a very appropriate amount in some investment account for potential growth and longevity as well. Because let's say you score like one year, it shoot up like what, 28% or 30% or something like that, like after 2008, then you're good to go. And then last but not least, we will talk about estate and legacy planning. This is non-judgmental. Again, this is a non-judgmental zone, but from my perspective, I'm a Vietnamese. I'm from Vietnam, and my parents, in the Vietnamese culture, all they think about is how much money can I leave for my children after I pass away. Right. And so Vietnamese people very focused on, legacy planning. I don't know how that is in America. It's, I have worked in finance for about 2 years now, and I have seen perspectives from a lot of different parties. But what I can tell you is estate and legacy planning is very, very important for generational security. If you know the story of the Vanderbilts versus Rockefellers, you are going to know exactly how important it is for, estate and legacy planning in preserving wealth. Look that up. It's very easy. Just go on Google and just type in Vanderbilt versus Rockefellers, and you're going to find out all that they did and what happened to them. All right, so let's move on. So a few these are very basic saving vehicles that I just kind of cooked up in a short amount of time. And I divided that in, like different time frame for you guys. So number one, we have short term. Short term should have high yield saving account. Number one, very, very important and very, very common. every single bank has it. Just make sure that you choose the bank that gives you the most return. I believe right now my bank is Capital One, and they give out 3.5%. Which I know is not the highest one, but I don't want to have to deal with all the hassle of going with a small banks, and what if they go bankrupt? Now, CDs. CD is also a very good vehicle for short-term planning because it's very predictable, right? It comes in months, like 3 months, 6 months, or even 1 year. But again, you have to have a really concrete plan. And once you put your money in CDs, you have to determine that you don't need to touch this money within this amount of time. Because if you do, during when the term before it mature, you are going to get slapped with penalty, and you don't want to do that. But that's why, in the terms of like a few months to up to a year, I would consider that short-term saving. And multi-year guarantee annuity, MIGA. MIGA stands for multi-year guarantee annuity. Now, this is a product by life insurance company. They are not really life insurance because they don't have the traditional death benefit that you usually see with life insurance. But multi-year guarantee annuity, think about it like an upgraded version of CD. But instead of working with a bank, you work with a life insurance company. And why? Well, this is another discussion for another day. But the feature of a multi-year guarantee annuity is usually they have a higher return compared to CD. So now in the market, CDs usually between 4 to 4.2% as the highest yield. But in a multi-year guarantee annuity, as I have insider insights, a 2-year MIGA right now is guaranteed at 4.8%. And a 3-year MIGA right now is at 3%. No, I'm so sorry, not 3%, 5.35%. So those are the shortest term that I can see in the market right now for MIGA. So because it's less than 4 years, so I'm going to put it in the category of short-term saving and short-term planning. Now, short to mid-term, we can also use CD because some CD goes up to 10 years, just so you know. It just depends on who you goes with and like all the restrictions that they put on. But I know on the market right now, there are a few banks that offer CDs up to 10 years. MIGAs can also go up to 10 years with different sets of, they all have different sets of rules, right? But there are, of course, going to be rules. Once the important things is once you decide to put your money in something that has a guarantee return for a certain amount of time, you have to make sure that you don't need to touch that money within that term. Because if you do, there are going to be penalty, and we're going to talk a little bit about penalty within the next few slides. Now, fixed annuity is also another vehicle with life insurance company that serve kind of the same way with MIGAs, but they don't guarantee a fixed amount of return for a period for a long period of time. Fixed annuities work like this. Every single year, the life insurance company is going to declare a fixed interest on your money. Could be higher than MIGAs, right? Come again with more risk comes more rewards. That happens every single time with financial services and even in life. So fixed annuity, if you have a higher risk tolerance and you have money set aside that you don't need to touch for a certain amount of years, you can definitely look into this option for short to mid-term saving. Now, mid-term saving, we're talking fixed annuity. I already talked about that. IRAs and employers sponsor plans with a match. Usually when I talk to a client who has a 401k or 403b, TSP, whatever, but if they don't have a good match, there's no point, to be honest with you. And if they can't max it out at $23,000 a year, I also don't see the point of doing that, because one of the main bonus, or the main reason people choose employer sponsored plans, is because they get a match. Let's say they match you 4%, even just 4%. That's yay, free money, right? Who can say no to free money? Well, I know I can't. I just have never worked in the corporate world, so I don't know anything about that. Um, and IRAs, we have traditional IRAs and Roth IRA, which are the do-it-yourself version of these employer-sponsored plan, and usually they have a lower limit, contribution limit for you. So if employer-sponsored plan, you can go up to 23,000 or 23,500,000. I mean, the $23,500 every single year. For IRAs, you can go up to 7,000, and they definitely have an income limit. So if you have too much money, sometimes you can't really contribute to IRAs, just so you know. Now, mid to long-term saving also have IRAs, employer sponsored, and fixed and index annuities. We're going to talk a little bit about this a little later. I just want to breeze through the slide right now. And long-term saving, definitely the IRAs, employer sponsored plan, and fixed index annuity. Now, the reason why they belong to the long term is because there are age restriction when it comes to distribution. And we're going to talk about that in the next slide, I believe. Nope, not this one, the next one. But anyway, before that, I want to touch point a little bit on the high yield saving account and CD. The reason why I do this comparison is because both of these products are provided by banks, not life insurance company, but banks. So high yield saving account, it has very high liquidity. As you see, you can always touch it. The money in there is 100% touchable at all time. Doesn't have any restriction in terms of time or anything like that. Now, however, CD does have very low liquidity during the term. You can choose anywhere between 3 months up to 10 years. But if you touch this money before it mature, aka before the term expire, you're going to get slapped with some kind of penalty. In terms of interest rates, for a high yield saving account, most banks are giving about 3.5 to 4.2%, with the highest as 4.2%. And remember, the return here is taxable, just so you know. Now for CD, it's fixed, right? So let's say you put your money in a CD today and you choose a 3-month term, or a 3-month term. The fixed interests, they are going to promise you to continue to credit you at that one fixed return every single month until the term expire, and then after that you can get your money back and you do whatever you want to do with it. And right now the highest rate that we have on the market is up to 4.27%, which is not very high in terms of wealth accumulation, right? Because when we talk about wealth accumulation, we have investment that can possibly give us 28%, or if you have pay attention to the S&P 500 alone, over the last 30 years, it has proven that the annual return is fall anywhere between 9% to 11%. So in terms of long term, this is not a very optimal option in my opinion. In terms of risk, for high yield saving account and CD, both are very, very low. You know exactly what you get because the bank already declared the return, and because the money in there is already in there, you don't really lose when the market goes down. It does not retire. It does not tie to the market. That's what I mean. So the risk here is very low, but then of course the reward is not that high either. In terms of access, you can access your money in a high yield saving account anytime, but for CD only at maturity. So at end of term, you can access it before the end of term, but just remember you have some kind of penalty to pay. Now, high yield saving account, definitely best used for emergency fund and short-term planning. And for CD, of course, plan short-term. So let's say you have a plan. I have some client like that right now, and he wants to purchase a property within this year. So I made him kind of have a plan and tell me what the mortgage is going to be, what kind of house he's looking for. And from that, we kind of calculate it backward. We find the house, we find the mortgage, and we find out how much money he has to plan ahead of time for that transaction. And then we look at how much money he can allocate or reallocate within his portfolio into a CD, right? If it's less than 4 years, CD is good. Actually, if it's less than 2 years, a CD is really, really good for that purpose. And basically, it's a planned short-term goal. You got to make sure that you don't have any other use for that certain amount of money, and you just leave it in there for 2 years. Set it and forget it. And then stress level, of course, because high yield saving account have everything that check the box for, liquidity and control and predictability. It's very minimal risk. Very, very, very minimal stress level for high yield saving account. And for CD, it is minimal if you plan ahead of time and you know that you do not need this money for this amount of time. So everything needs planning. That's why I work in financial planning. Now, moving on, we have MYGAs and versus fixed annuity. Now, MYGAs and fixed annuity, think about it like the high yield saving account and CD, but in the life insurance world. Those are two very different worlds, by the way. Banking and life insurance are two very different worlds, but usually they come together to complement, because bank can only, again, guarantee you up to 10 years. But with life insurance company, there are products that can guarantee so much longer than that, 15 years, if we have to put it down to the number. So what is the difference between multi-year guaranteed annuity and fixed annuity? So the rate structure, number one, is very, very different. So for multi-year guarantee annuity, basically it is like a CD. It's just a longer term. So you have 2 years term, 3 years term, 5 years term, 7 years term, 10 years term, 15 years term. You can choose a term, and during the term of that, basically the money is going to just grow on the declared guarantee rate at the beginning of the contract. So that is not going to change during the full term, no matter what. Now for fixed annuity, they declare it either every year or every 2 years, depending on the products and depending on the company that you go with. But during that time, it's not going to change. But every single year or every 2 years, the life insurance company can tell you, hey, this is the new rate, and there's nothing that you can do about it. That's why, with fixed annuity, it's higher risk, but also higher reward, because it can go higher than the guarantee rate that multi-year guarantee annuity gives. Now, in terms of time horizon, for multi-year guarantee annuity, that is short to midterm. So again, we're talking 3 to 10 years. But for fixed annuity, you can go up to 15 years or even above that. So again, this is a very, this is a extended or, more like longer type of product if you're looking for guarantee, somewhat guarantee return for your investment. Now, in terms of liquidity, most annuities have a limit when it comes to withdrawal during the term. So it's not there, just like CD, you have a penalty that you have to pay if you touch that money before the term expired, right? So just like that, annuities also have that same problem or the same limitation. And for most products, after the first year, you are only allowed, for MYGA, you're only allowed to touch up to 10% of the entire amount you have in the contract. For fixed annuity, you get you start at 10%, but then over the year, the longer that you leave it in there, the more money you get to touch. So that again depends on the type of product and the type of company that you go with. In terms of tax treatment, both of these are tax deferred. So think about your 401k. If it's not a Roth, it grows tax deferred. Basically, right now you don't have to pay tax on the growth, but then when you start withdrawing, that's when you pay tax. Now, income focus. MYGA is not supposed to be an income product like a lot of another annuities do. So for MYGA, you basically just use this as an alternative for CD, but longer term. and better return. And for fixed annuity, there is an option for you to turn it into an income, like a pension afterward when the term, expire. You can do that, or you can roll it into a different product and just keep going with the strategy if you like it so much. There are a lot of nuances with annuities, and I would love to help you, navigate through the world of annuity. If you think after today, you think that that might be an option that is good for your financial planning. Now, complexity for MIGA, again, it's very simple. It's exactly like CD. It's just longer term and it has some flexibility, and what you get on paper is exactly what you get in real life. For fixed annuity, that's moderate because, again, remember, life insurance company can change the rate from time to time. So definitely not that high of a peace of mind, but sometimes it gets the reward that you want, which is higher than what MIGA can offer. Now, let's talk about the retirement alphabet soup. So, we know what that is, right? IRA, 401k, 403b, TSP. I actually wrote a whole article about this on my website. And if you didn't catch my website earlier, it's www.mymoneyumbrella.com. So just go on there, and there are a whole classroom waiting for you to read. But anyway, going back to the retirement alphabet soup. So let's talk about tax. Traditional IRA and most of the employer sponsored plan are, tax later, except if you deliberately choose the Roth option within the employer sponsor. Remember, anything Roth is going to be tax now. You pay tax now on your income, and then you use whatever left over to fund a Roth IRA. That's basically you already, fulfill your tax duty to Uncle Sam. So after that, when you retire, he give you a break. And for traditional IRA and employer sponsor plans, that is going to be, taxed later because you're not paying tax now. It gets reduced from your paycheck right now before it even get taxed. So that's why you have to pay tax at the end. Uncle Sam does not let tax go. Just remember that. Now, in terms of growth, traditional IRA grow tax deferred, meaning that, again, you don't pay tax now, right? The grow is just keep stacking up until the day that you have to withdraw. Now, for Roth IRA is tax free. It grows tax free. Again, remember, if you already pay tax now and you contribute to this after tax, then the growth is going to be tax free, and then the distribution in the long run is also going to be tax free. And for employer sponsored plan, again, depending on the plan that you choose, it could either be traditional or Roth, it depends. If it's traditional, you're gonna go grow the money tax deferred. But if you choose the Roth option, it's going to be tax free. Access, traditional IRA has a very restricted access. But we'll talk about that in the next slide. But for Roth IRA, contribution is tax free. So at any time, contribution is the money that you put in the Roth, right? So at any time you can withdraw it tax free, but only the contribution portion though. Any growth on top of that is not going to be withdrawn tax free. And if you access it before you are 59 and a half, oh shoot, I gave out the next slide already. But if you touch that money before 59 and a half, you are going to have to pay some kind of penalty on it. And for employer sponsored plan is the most restricted of all. Just remember that. You're working with a corporate. So basically that plan belongs to the corporate. So of course they are going to slap you with restriction here and restriction there and limit here and limit there. Remember that. Now, income limit, traditional IRA, yes, there is an income limit before you can actually put the money in it. Again, for traditional IRA and Roth IRA, if you make too much money, you are not going to qualify to contribute to these plans. Now, for employer-sponsored plan, there is no restriction, there's no income limit, but just make sure that you don't over contribute because they have a ceiling. 23, I remember it's 23,500 for the year of 2026. And there are also some catch-up contributions that you can look up if you are over the age of 50. Employer match for traditional IRA and Roth IRA, because they're the do-it-yourself version, you don't get any match. But for employer sponsor plan, maybe, because some companies do not give matches. And for those company, let me tell you, just come to me. I'll find you a better deal. But most employer plan that I know give out a match up to like 4% or sometimes 8% that I have seen. But that is a good deal. That's free money. Do it. Now, we talk about penalty, right? So there are, of course, age restriction with these vehicle. Most common is the 59 and a half years old rule, right? Basically, if you touch the money before you turn 59 and a half, you are going to have to pay a penalty. And for Roth, you can touch your contribution before 59 and a half, but if you touch the earning, then it is going to be penalized. Yes. Access to contribution, as I said before, right? Only Roth IRA, you can do that without any penalty. RMDs, required minimum distribution, right? So by the time that you are 73 years old, if you have failed to make withdrawal from your traditional IRA or your employer plan, you are going to get slapped with a penalty that, a penalty of 25% of the amount that you were supposed to withdraw that year. Just so you know, look this up, please, because a lot of people are completely unaware of this rule. And when I tell them about that, they're like, what? Why do they have to do that? Because Uncle Sam, again, if he allows you to grow your money tax deferred for so many years, then at the end of it, he has to get his tax back at one point. Nothing is free lunch in life, my friends. So yeah, just be careful with the RMD rule. And then last but not least, we talk about practical uses for these vehicles. So for traditional IRA, I would advocate for mid to long-term planning. Also Roth IRA, because you have exceptions that applies to first home buyer for the traditional IRA. And for Roth IRA, you can also save money, like use it as a partial saving account where you can touch the contribution. But for employer sponsor plan, 100% just long-term, please. Do not touch that money before you turn 59 and a half unless you really, really have to. All right. So I'm going to go deep into this one. So for HISA, now we talk about risk management, like which vehicle is good for risk management, which vehicle is good for wealth accumulation, right? And the notes, the reason why. So for HISA, it's primary for risk management. This is the summary. Primarily for risk management, and definitely not recommended for wealth accumulation, because 3.5%, hello guys, you guys can do much better with other vehicle. But the upside is full liquid. For CD, risk management 100%, because it's so short. And then also I do not recommend it for long-term wealth accumulation. And remember, there's penalty if you access it prematurely. For MYGA, I would say this one fall into risk management as well, because it protect your money in terms of down market. It does not lose your principal in down market. So primarily for risk management. Now, if you want to use it for wealth accumulation, you can, but if you can live with 5.35% for, I don't know, for the next 3 years, and then you just keep rolling it into the next products and blah, blah, blah for like, the next 30 years of your life, by all means do that. But then at the same time, it also has the same restriction as CD, but it's more predictable because 10% every single year after year one. For fixed annuity, down market protection, because all the annuity that I have, all the fixed annuity that I have is, down market protection. You do not lose your principal in down market. And also for fixed annuity, this one provides you with longevity protection, because you can convert this into pension for life. For wealth accumulation, like if you focus on growth, do not do this, because it gives you very, very light growth. It usually have a cap right? It's probably like what, 7%, 8%. But it's if you don't like to be stagnant and you want to risk it in the market with like 28% some year, 30% some years, please do not choose this and then go back and like throw a tantrum on your agent when the money does not grow as you as you expected. For traditional IRA, Roth IRA, and employer plan, I do not recommend these for risk management, because as you dig into the money prematurely, you are putting a damper on the growth for your long-term wealth accumulation. So I do not recommend this for that purpose, and only recommend these vehicle for wealth accumulation. Sorry, I keep checking my time because I don't want to go over time. We have about 6 more minutes. So 2 more slides, I swear. Growth plus safety means security. A lot of people talk about financial security, but what does that actually mean? Does it mean $10 million by the time that you retire? Or $15 million? Or $20 million? Nobody knows, right? It depends on your lifestyle and what you need to do, or whatever your goal is. But for me, financial security means you have a solid risk management foundation. Doesn't matter if the government shut down tomorrow for like 3 whole months, or if you lose your job and you can't land the next gig for the next 6 months, whatever. You don't have to worry about a thing. That means financial security right there. And that start with a very solid risk management foundation. Now, sustainable growth strategy, you need to choose a strategy that you can continue to put money in every single month or every single week. Doesn't matter what happened. This one is sustainable for the next 5 years, 10 years, even 30 years, if you might. And then last but not least, long-term planning with a specific goal and priority. A lot of people just go with the flow. Oh yeah, like I see the market now is down to like 4.5% interest, so maybe now is the time to buy a house. But with what money? Did you plan ahead? Do you have the resources to actually purchase that house, or are you going to bind yourself in for the next 30 years with like no mortgage, no down payment, and like just keep going with a high interest or high payment? This is the reason why buying a house is actually a financial event that you plan for before the fact for about a couple of years at least. Now, for financial security, the things to avoid is to go way too extreme. So I do not sit very well with really high risk only strategy or really, really extreme risk avoidance strategy. So think about it. Like if you have all your money in the stock market, that is not a good strategy because it's high risk. The market can tank anytime. Look up the Great Depression in 2008. It's very recent. And then extreme risk avoidance strategy. If you avoid all risk, you eliminate all risk, and you just go really, really careful, then you are going to deal with something we call lost opportunity as well, because sometimes the market does really, really well. Let's cut through the real life scenario because we don't have much time right now. But let me just end with real estate acquisition as a financial event that you need to plan ahead of time. So financial planning, not even just for the house, but financial planning in general is a long-term play. You need to have annual checkup. Think about your health, right? If you go to the doctor every single year to make sure that nothing is serious is going on with your health, then you can do the same with your finance. And it's important, right? Frequent updates, because sometimes your health change. So does tax code. So does, government regulation. So does everything that is going on, high interest rate, CDs going down. The rates can go down and up anytime, and you need to update it every single time that it changes. And then after that, you need to have strategies, changes due to life events. Sometimes you get married, you have to change things within your financial, budget. Sometimes you get a new house. You have to pick out your new priority, right? So also, real estate acquisition is a major life event. It's in the financial industry. Whenever a person acquire like a new piece of real estate, especially when they have a family, that is considered as a major life event, because now you have a budget need, right? This is not something that you purchase 1 year and like be done, unless you have all the cash in the world. But we're talking about a 15 years loan or 30 years loan, so you have to plan ahead of time. Planning ahead is a game changer every single time. Ongoing funding, again, 15 years to 30 years. So you have to have that discipline. You have to make sure that you are going to be able to sustain that lifestyle and sustain that funding. And then you need to make sure your income is going to cover that as well. Family, if you have a family and you get a new piece of real estate, just make sure that you know what you want to happen to that piece of real estate after, like, let's say if you pass tomorrow. At the end of time now, so I'm going to pause right here.